Welcome back to the Deep Dive, where we take complex topics, strip away the noise, and deliver the essential insights you need to be truly informed.
We're diving into something today that most of us interact with constantly, often multiple times a day, without ever really stopping to think about the massive multi-trillion-dollar infrastructure that's sitting behind it.
Right, it's that rectangular piece of plastic,
Huh?
or maybe sleek metal if you're a rewards connoisseur, just sitting there in your wallet.
Exactly.
And the scale of this thing is it's astonishing. When we started pulling the sources, we found that as of mid-2018, there were over 7.7 billion credit cards in circulation worldwide.
7.7 billion.
And in the United States alone, by 2020, that number was a staggering 1.09 billion. So, if you're a consumer in the U.S., you likely have, on average, 3 to 4 cards in play right now?
Yeah, at least. And it feels like simple convenience, a digital version of cash, but it's anything but simple. This little piece of plastic is really the operational interface for a complex financial machine.
A machine that connects who? Banks, merchants.
Banks, merchants, consumers, payment processors, global regulators. It's a whole mechanism built on algorithms, on risk assessment, and fundamentally on debt.
Okay, so let's unpack this. Our sources today are dense. They cover everything from, Depression-era metal plates all the way to modern antitrust lawsuits and global regulatory wars. So our mission is pretty clear. We want to go beyond the usual usage tips to really understand the history of this instrument, the hidden mechanics that happen in milliseconds, and the enormous, often invisible costs this system imposes. Not just on the user, but on society as a whole.
And I think we should start by defining the subject right away, because even the definition can be a little confusing. We are focused today on the revolving credit card.
Okay.
This is the card, typically issued by a bank that allows you to purchase things or withdraw cash on credit. This transaction accrues debt that you, the consumer, have to repay later.
And that concept of revolving debt, that's the key, right? That's the crucial distinction. We need to remember this is fundamentally different from a charge card.
Exactly. Charge cards, which, companies like Diners Club and American Express made popular early on, they traditionally require you to repay the balance in full at the end of every statement.
So you get credit for a month, but you can't carry that balance over.
Right. No carrying a balance. And both of those are completely different from a debit card.
Which is just your own money.
It's just your own money. It instantly deducts the purchase from your checking account. No credit, no debt. So yeah, our focus is the system that's built entirely around credit, the system designed for you to potentially borrow money.
It's easy to assume the credit card is, a child of the post-war economic boom, the 1950s.
Yeah.
But the idea of using some kind of token to represent a debt goes way, way back, late 19th century.
That's right. Before plastic, merchants used what were called charge coins or customer tokens. These were small physical identifiers, often made of celluloid, copper,
It's like
aluminum.
the little coins.
Actual metal coins, yeah. And they were mainly issued by hotels or big department stores to their established customers, people who had a charge account directly with that one business.
So it was really localized, like a store loyalty card, but with actual spending power.
Exactly. The token usually had the customer's account number on it, the merchant's logo embossed right there. They were practical, too, often shaped with a hole so you could keep it on a keyring.
And the point wasn't just identification.
No, it was about efficiency. When you made a purchase, the clerk would physically use that token to imprint the account number onto a paper sales slip. And that dramatically cut down on manual errors in the back office, which was, a huge logistical headache back then.
Okay, so that idea of mechanical imprinting, that seems like a direct line to the next big leap.
Yeah.
The Charga plate in 1928.
The Charga plate was an early and I think essential precursor to the modern card. It was a little sheet metal rectangle, maybe 2.5 by 1.25 inches.
Not quite the size we know, but getting there.
Right. Still recognizable as an ID, like a modernized dog tag, really. It was embossed with the customer's name, their address, all the account details.
And how did that work in the store?
Well, it used this piece of equipment. A lot of people compare it to an old military printing device, like an addressograph. The clerk would place the plate into an imprinter, and an inked ribbon would press that embossed info onto a multi-copy paper charge slip.
Ah, so it automated the paperwork.
It standardized it, yeah.
Yeah.
Sped up transactions immensely. It was a staple of retail from the 30s all the way through the late 50s. It's funny, some stores would even keep the plate on file, and the clerk would have to go retrieve it after verifying who you were.
So we've moved from these single store accounts, and now we get to the idea of consolidation. Which brings us to 1934 and the air travel card.
This was a critical moment because it wasn't just a single store anymore. It was the first cross-merchant or cross-airline system. It was launched by American Airlines and the Air Transport Association.
And it let passengers buy now, pay later across multiple airlines.
Across multiple carriers, yeah. They created a standardized numbering system that identified both the issuer and the customer account.
And the incentive to use it must have been huge.
It was. Travelers got a 15% discount on air travel if they paid using this card system. That's a serious lever for mass adoption.
15% is massive.
It absolutely was. And the system was so successful that by the 1940s, all the major U.S. airlines were in on it. By 1941, the air travel card accounted for nearly half of all airline revenues.
Wow.
And that success led directly to it becoming the first internationally valid charge card in 1948, accepted by all the members of the International Air Transport Association, or IATA.
And here is a tiny, wonderful historical nugget for you, our listener. The source notes that the reason modern UATP, that's the Universal Air Travel Plan cards, still start with the number 1. It's a direct legacy of that original 1934 numbering scheme, a link across 9 decades of payment tech.
Amazing, isn't it? Then the general purpose card arrives in the 50s. In 1950, Raoul Schneider and Frank McNamara founded Diners Club.
And this was the real transition. A single card for all sorts of different places, restaurants, shops.
Right, it consolidated the wallet. But, crucially, it started as a charge card. You had to pay it off every month. American Express followed pretty quickly in 1958 with its own charge card.
But the real disruption, the birth of the machine we're talking about today, that needs the system to pivot from monthly repayment to revolving credit. And before 1958, a bunch of small banks tried and failed to create that system.
They did. This was the famous chicken and egg problem.
That phrase perfectly captures it.
It really does. Consumers wouldn't sign up for a card that merchants didn't accept, and merchants wouldn't buy the equipment for a card that nobody carried. Bank of America just blew that cycle wide open in 1958.
With the launch of the BankAmericard in Fresno, California.
And this is universally seen as the first successful modern credit card offering revolving credit.
Why Fresno, though? Why start there specifically?
It was strategic brilliance. Or maybe recklessness, depending on how you look at it. Bank of America had incredible market penetration in Fresno. 45% of the residents were already customers.
Okay, so they had a built-in base.
A huge base. And to guarantee merchant adoption, to just force a solution to that chicken and egg problem, they made an unprecedented, really audacious move. They sent cards unsolicited to 60,000 residents, all at once.
Wait, they mailed active credit cards to people who didn't ask for them. That sounds like an absolute disaster waiting to happen.
It was a monumental disaster. It created monumental chaos. These mass unsolicited mailings were quickly dubbed drops in the banking world.
And the financial vetting must have been
Non-existent. The vetting was minimal, if there was any at all. Accounts from the time are just shocking. Cards were mailed to, and I'm quoting here, unemployable people, drunks, narcotics addicts, and to compulsive debtors.
Oh, my God.
The financial losses for Bank of America in that first year alone were estimated at over $8 million, a massive sum in 1959.
That is just a powerful illustration of the lengths they went to get this system off the ground.
And the public outcry, the bankruptcies. It was so severe that these unsolicited mailings were eventually outlawed by Congress in 1970.
But by then, the damage was done, or the foundation was laid.
Exactly. By the time the law took full effect, an estimated 100 million credit cards had been dropped on the U.S. population. It created the entrenched system we know today.
And from that chaotic start, the networks we know today began to form. BankAmericard evolved, and in 1976, all its licensees united under the brand we now know as Visa.
Right. And to compete, a rival group of banks established MasterCharge in 1966, which eventually became MasterCard.
And this wasn't just a U.S. thing.
No, it went global. Barclaycard launched the first credit card outside the U.S. and the U.K. in '66. But it's important to remember this wasn't universal. In places like France and Japan, they had stronger cash traditions, so the adoption of revolving credit was much slower. It gave rise to other kinds of cashless payment systems first.
Okay, so we've covered the tumultuous history. Now let's drill down into the physical card itself and that complex electronic flow that happens the millisecond you decide to tap to pay.
First off, the card itself is highly standardized. It conforms to a global standard, ISO AE 7810 ID1, which dictates its precise size, 85.60 by 53.98 millimeters.
And they're usually plastic, but we're seeing more metal ones now.
Yeah, the metal cards really reflect their status as a kind of luxury financial product.
And the numbers on the card, the 16 digits, they're not random, right? There's a structure to them.
Not at all. They comply with another standard, ISO IC 7812, and the first 6 digits are absolutely critical. They form the bank identification number, or BIN.
And the BIN tells you what?
It identifies the bank that issued the card in the network, Visa, MasterCard, Amex, and so on. The next 9 digits are your individual account number, and that very last digit is a simple but essential validity check digit.
To make sure the number wasn't miskeyed or something.
Precisely. It's a simple algorithm that ensures basic integrity.
It's so interesting how some of the physical features are just historical baggage. Like,
Yeah.
the numbers are often still embossed,
Yeah.
which is a leftover from the charger plate era.
It is. It's a legacy from when they needed to be transferred onto carbon paper slips. Even though we never use those anymore, the structure just persists.
That's starting to change, right? I've seen cards with the numbers flat on the back now.
Yeah, embossing is gradually being phased out, but security has moved on so quickly. We went from the magnetic stripe, which is very easy to copy.
Hit the chip?
Right, to the EMV chip. That's Europay MasterCard Visa. It's a smart card tech that generates unique codes for each transaction, which drastically reduces physical forgery or skimming. And now we're even seeing cards with little keypads and fingerprint sensors built right in.
Okay, now for what might be the most confusing but also the most essential part of this whole deep dive, the ecosystem. When you tap your card, you're not just talking to the store. You're starting a conversation between, what, at least 8 distinct parties?
It's an electronic ballet. It truly is. And this complex structure is what guarantees the security and, more importantly, facilitates the movement of billions of dollars across totally separate financial institutions instantly.
Okay, let's break down these 8 roles. The first 2 are simple.
Right. Number 1, the card holder. That's you. Number 2, the merchant, the business you're buying from.
Easy enough.
Then 3, the card issuing bank. This is your bank. The one that extends you credit, sends you the bill, and most critically, bears the fraud risk and the risk that you won't pay your debt.
And number 4.
Number 4 is the acquiring bank. This is the merchant's bank, the institution that processes and accepts the payment on the merchant's behalf.
So you have your bank, and the store has its bank. That's the 4 main players. But who sets the rules of the game?
That's number 5, the card association. This is Visa, MasterCard, American Express. Think of them as the rule book and the brand. They set the transaction terms, the interchange rates, all the standards for the other banks.
And number 6.
Number 6 is the transaction network. This is the actual electronic pipeline that implements the mechanics of the transfer. It's the wires. While it's often owned by the card association, like VisaNet, it can sometimes be an independent third party.
So, if I'm getting this right, the card association is like the government that sets the laws, and the transaction network is like the postal service that securely delivers the mail.
That's a perfect analogy. The association is governance, the network is infrastructure.
Okay, and the last 2 are more behind the scenes.
Very much so. Number 7 is the Independent Sales Organization, or ISO. They basically resell the acquiring bank services to smaller merchants. And number 8 is the affinity partner, like a university or sports team that lends its brand name to a card for a fee.
Got it. So now let's trace the money through the interchange process. There are 4 steps once you tap the card.
Right. Step 1 is authorization. The merchant sends your transaction details to their acquirer. The acquirer passes the request up to the card association, which routes it to your issuer.
And my bank checks if I have enough credit.
Exactly. It checks your validity, your credit limit, and if it's all good, it reserves that amount and sends an approval code all the way back down the chain. This whole process takes less than 2 seconds.
Incredible. And step 2.
Step 2 is batching. Authorized transactions aren't settled one by one. The merchant usually aggregates all the day's transactions into a batch and submits it to their acquirer, usually at the end of the day.
So what happens if they forget to submit the batch?
Well, the authorization hold on your account will eventually just expire, and your credit gets freed up. The merchant loses the sale.
Okay, then step 3. Clearing and settlement. This is where the actual money moves between the banks.
This is where the card association takes center stage. It debits the card issuing bank, your bank, and credits the acquiring bank, the merchant's bank. Your bank pays the store's bank.
And finally, step 4. Funding.
This is where the acquiring bank pays the merchant. But here's the essential part. It pays the merchant the total batch amount minus the agreed-upon fees. These are the discount rates or interchange fees, which are the lifeblood of the whole system.
And then there's the dreaded interruption to this whole flow, the chargeback.
Right. This is when you, the cardholder, initiate a dispute. You say, I didn't authorize this, or the product was broken.
And that's a huge risk for the merchant.
A major risk and cost. Your issuer returns the transaction to the acquirer, who then forwards it to the merchant. And the merchant has to either accept the loss or try to contest it with evidence. So while your bank assumes the risk of you defaulting, the merchant assumes the risk of disputes.
It's just a remarkable system. Layers of interconnected risk, all adjudicated in milliseconds. It's a miracle of global finance that this chain, involving 8 different parties, takes less time than it takes to unlock your phone.
Now we have to shift focus to the cardholder and really the foundational engine of this whole multi-trillion-dollar system, revolving debt.
And the first gate you have to pass is the credit limit. It's decided based on a complex risk profile, right?
Yeah.
Credit score, income, existing debt.
All of it. And the system is severely tiered. It really concentrates lending capacity at the very top.
The divide is pretty stark, I imagine.
It's huge. Prime and super prime borrowers, so FICO scores generally above 740, they're the most desirable customers. Data from 2022 show that these top tiers account for an astounding 80% of the entire available credit line capacity in the U.S.
80% of over $5 trillion.
Exactly. They get limits of over $10,000, sometimes much, much higher.
And on the flip side, you have the subprime borrower.
Yeah.
The score is below 620.
And they often start with limits as low as, say, $300 to $1,000. They represent much higher risk, so the system gives them the least capacity at the highest cost. The median limit for a prime borrower was around $7,100, while for subprime it was just $1,500.
And that high cost is enforced through the infamous minimum payment trap. The system is explicitly designed for a portion of the population to become what they call revolvers.
People who carry debt from one month to the next. If you don't pay your balance in full, you have to pay a minimum. And the moment that deadline passes, high interest rates kick in, sometimes compounding daily. And that interest burden is just incredibly lucrative.
And we should also address the most insidious danger, even if it's been regulated now: negative amortization.
That's a critical term. It was banned in the U.S. in 2003, but it perfectly illustrates the predatory potential here. Negative amortization is when the required minimum monthly payment is actually less than the finance charges and fees for that month.
Meaning what, exactly?
Meaning that even if you pay the required minimum every single month on time, your total debt increases. The balance just grows and grows. It ensures the customer is perpetually locked into debt.
Wow. And stepping back from the mechanics, there's a psychological element too. Research shows we just spend more with plastic because we don't feel that immediate pain of payment you get from handing over physical cash.
That psychological element feeds right into the confusion around the grace period. Most cards offer one, usually 20 to 55 days, where you can pay your balance in full and you don't get charged any interest.
But if you miss that zero balance threshold even once, you're in a financial minefield.
You lose the grace period completely. And the consequences are immediate. If you roll over even a tiny balance from the last cycle, the grace period is usually gone. So interest is charged retroactively on the old balance and on every single new purchase you make, starting from the exact date of that purchase.
Not from the statement date, but from the moment you swiped. That's what shocks people.
It is. And it connects directly to the notorious residual retail finance charge, or RRFC. We should walk through an example here because it's so confusing.
Yeah, let's do that.
Okay, so let's say you had a $5,000 balance when your statement closed on the 1st of the month. You then use the grace period, and you pay off the entire $5,000 on the 15th. You think you're at zero.
Right, paid in full.
But your next statement on the 1st of the following month will still have a charge on it. That's the RRFC, the interest that accrued on that $5,000 balance for the 15 days before you paid it off.
So even though I paid it in full, I get a bill for, what, $35 of trailing interest. And I'm thinking I missed a payment or miscalculated.
Exactly. It feels like a surprise fee, but it's the lingering cost of having rolled over that balance the cycle before. And compounding all this are penalty rates.
Right, where your rate can just jump to 20 or 30% for one late payment.
Yes. And we've seen the extremes. I mean, it was discontinued in 2011, but First Premier Bank once offered a credit card with an APR of 79.9%.
79.9%. That's just,
yeah.
That basically guarantees you'll be locked into debt forever.
It does. And if the interest rates weren't high enough, let's talk about the most expensive way to borrow money on a card: cash advances.
Ugh. Yeah.
They are highly discouraged for a reason. You get hit with an immediate fee, usually 3 to 5% of the amount, plus a much higher interest rate than regular purchases.
And the worst part is the interest starts immediately.
Immediately, compounding daily. Unlike purchases, there's no grace period. Even if you pay your statement in full, that interest is not waived.
And the system has found clever ways to classify certain things as cash advances without you even realizing it.
This is a crucial point for anyone listening. Network guidelines often classify things like buying lottery tickets, money orders, or casino chips as cash advances.
So you think you're making a purchase, but you're actually taking out a high-interest loan.
You are. And buying prepaid debit cards or even using your card in a mobile payment app for a peer-to-peer transfer, that can also be flagged as a cash advance. It's a huge risk.
And this mechanism can be exploited. I know our sources pointed to a really shocking example of this in Japan around 2010.
This is a perfect case study in loophole exploitation. Following a law change, online shops in Japan set up these schemes. They would sell you a virtually worthless item like a single glass marble for an insane price, say 100,000 yen, which is about $1,200.
They charge that to your credit card.
Right. And then they immediately wire you 80,000 yen as cash back.
So you get 80,000 yen in cash today, but a month later, you owe 100,000 yen on your credit card bill.
Exactly. The shop provided a short-term, high-interest loan disguised as a retail sale, completely bypassing all the lending regulations. The effective annual interest rate on these things was around 300% APR.
And the shop has no credit risk.
None. The card owner is just saddled with the high-interest debt. It just shows how easily the whole credit mechanism can be warped when regulation lags behind.
The cardholder bears huge risks, but we need to pivot now to the other side of this economy, the merchant. Why do businesses accept these cards when they are so expensive to process?
Well, the benefits are just too substantial. It's unavoidable in modern commerce. First, consumer resistance to buying something is much lower compared to demanding cash.
Makes sense.
Second, security. It's way safer than handling large volumes of cash, reduces theft, reduces all the back office work.
And the most important benefit. The issuer, my bank, assumes the credit risk.
That's the crucial guarantee. Once that authorization comes through, the issuing bank guarantees payment to the merchant's bank even if you, the cardholder, later default. That risk assumption is vital for commerce.
But all these benefits are paid for by the massive burden on the merchant. The interchange fees and discount rates.
This is the core engine of the whole plastic economy. For every single transaction, the merchant pays a commission, the discount rate, which typically ranges from about 0.5% to 4% of the sale price.
And the structure is a complete labyrinth.
It is. The fee changes based on the type of merchant, their sales volume, whether the card was physically present. Online sales cost more because of fraud risk, and critically, the type of card you use.
Right. If you're using one of those premium high rewards cards, the merchant is paying more to the card issuer for that privilege.
Absolutely. Those high-tier rewards cards, the ones with 2% cashback or travel points, they come with a higher interchange fee. The merchant is, in effect, funding your reward points.
And this high cost is what triggered those major legal battles in the U.S.
Exactly. Merchants argued that Visa and MasterCard had a monopoly and were setting unfairly high rates. This all culminated in a huge class-action antitrust settlement in 2013.
Valued at, what, $5.7 billion?
$5.7 billion. One of the largest antitrust settlements in U.S. history.
But the fight didn't end there. Big retailers like Walmart and Amazon actually opted out of that massive settlement. Why?
Because they felt it didn't fix the core structural problem, which was the ability of the networks to just keep setting these fees at what they saw as excessive rates. For them, it was illegal price fixing.
So even a multi-billion-dollar payout was less important than trying to gain control over their ongoing costs.
For them, yeah. By opting out, they were signaling they were going to keep fighting against what they saw as a mandatory anti-competitive tax.
And this brings us to the most significant social detriment of this whole economy: inflated pricing for all consumers. This is the crucial takeaway for the listener on the hidden costs of convenience.
Yes, because the merchant has to cover that 0.5% to 4% fee somehow. But they usually can't charge it directly to the card user without risking customer backlash.
So they just raise the base price of everything. For everyone.
For everyone. They raise the prices of all their goods and services to cover that blended average cost. Which means that if you are a consumer paying with cash, or a low-fee debit card, you are effectively paying a hidden tax on every single item to subsidize the cost of processing high-fee credit cards.
It's a deeply regressive system. The scale of this subsidy is just massive. In the U.S., in 2008 alone, credit card companies collected $48 billion in interchange fees.
Which averaged out to $427 per family when you spread it across the economy.
And that cost is most clearly funneled into the rewards programs, the cashback, the airline miles that the most affluent and savvy consumers love.
Exactly. Those rewards programs cost the issuers a lot, usually between 0.25% and 2.0% of the transaction. And that is entirely funded by the higher network fees charged to merchants.
So those rewards aren't free. They're financed by higher prices paid by everyone else.
Precisely. And this creates a quantifiable wealth transfer. Research analyzing these programs suggests they result in an estimated transfer of $1,282 annually from the average cash payer to the average card payer.
That is a staggering figure. Let's just sit with that. An annual financial transfer of resources subsidized by the less affluent who are more likely to use cash, all in favor of the high-volume user, the transactor, who pays their balance in full and reaps the rewards.
It raises profound questions about social welfare. The people who benefit most from the rewards are those financially secure enough to never incur interest. The people who absorb the cost through inflated prices are those who may rely on cash or are already struggling. The system is structurally designed to reward the wealthy and transfer costs downward.
So the convenience we all enjoy is predicated on this embedded hidden tax that ensures the most lucrative customers are heavily incentivized to keep using the network.
Okay, moving beyond the standard model, the market has created some specialized card types to address specific needs or, exploit specific markets.
Let's start with the one explicitly designed to help people enter the market or recover from financial trouble, the secured credit card.
Right. This is where you have to put down a cash deposit with the bank, often 100% or even 200% of your credit limit. That deposit serves as collateral. It mitigates the risk for the issuer, so they can offer credit to someone with no history or bad credit. The key benefit is that your activity is reported to the credit bureaus, so you can actively build or rebuild your credit score.
But even with that secured system, there's a significant hidden risk.
That's right. The deposit isn't a prepayment. If you miss a payment or two, the issuer doesn't just take the deposit right away. The account first goes through a long delinquency period, like 150 to 180 days.
And during those 5 or 6 months?
Interest, late fees, penalty rates, they all keep accruing at high speed, so the total debt you owe can easily end up being way more than your original deposit. You end up forfeiting your collateral and still having a big debt that goes to collections.
Which completely defeats the purpose of rebuilding your credit in the first place.
It makes careful management absolutely essential.
Okay, next, the confusing category of prepaid cards. They often have Visa or MasterCard branding, but they're not credit cards.
Not at all. They're just stored value cards, functionally identical to debit cards. You load your own money on and spend it down. They're often marketed to teens, but they frequently carry high fees, activation fees, purchasing fees, monthly fees.
As our sources note, consumer agencies often call them an expensive way to spend your own money.
Yeah. And then you have business credit cards. Approval for these often relies on the business owner's personal credit score. The key feature, though, is that some issuers won't report the account activity to your personal credit file unless the account goes delinquent.
Which helps separate your business and personal debt.
Exactly. Now, with all these products, security is paramount. The industry's goal, as they admit, isn't to eliminate fraud, but to reduce it to manageable levels.
And that means multi-layered defense. The EMV chip was the big one against physical forgery. We also have the CVV code on the back for online transactions.
But remote purchases are a different threat, and the solution there includes things like virtual cards.
That's where you can generate a unique, single-use, 16-digit number that's tied to your real account.
Right, so if that number gets compromised in a data breach, it's useless to a thief. It protects your actual account details.
And let's not forget the old-school analog security response, the Code 10 call.
This is a classic. It's a signal between the merchant and the payment network. If a merchant is suspicious about a card or a user, they call the operator and say, Code 10.
And the operator just asks yes/no questions.
Just yes/no, so the customer can't hear what's going on. If the card is flagged as stolen, the merchant might be asked to retain the card if it's safe to do so, and they often get a little reward from the bank for it. It's a fascinating analog procedure in a digital world.
Finally, let's look at the regulatory guardrails. And regulation varies dramatically, country to country.
In the U.S., the big one was the Credit Card Act of 2009. It addressed a lot of predatory practices. Critically, it made companies inform customers 45 days before certain fee increases and required you to actively opt in to over-limit charges.
Right, if you don't opt in, the transaction just gets declined.
And maybe most helpfully, it requires bills to clearly show how long it would take to pay off your balance if you only made minimum payments. It forces you to confront the true cost of debt.
But the U.S. system is still a high-fee, high-reward model. The EU took a much more radical approach.
They did. The EU interchange fee cap from 2015 fundamentally altered the business model for card issuers in Europe.
How so?
It imposed a maximum fee, 0.2% for debit cards and 0.3% for credit cards.
0.3%, compared to the U.S. average of, what, 1.73%?
Exactly. That difference is transformative. It immediately made all those lucrative high-reward card programs pretty much unprofitable in the EU.
Because the money to fund the rewards just wasn't there anymore.
It wasn't there. And that one regulation fundamentally changes the whole social welfare dynamic we talked about. If the reward money is limited, that hidden subsidy from cash payers to card users is dramatically reduced.
And finally, the French banking system offers an even more restrictive contrast.
France is very risk-averse when it comes to consumer debt. They have cards branded as Visa or MasterCard, but they're often not revolving credit in the American sense. They're more like an end-of-month debiting system.
So your bank account is just automatically debited for the full balance at the end of the month.
In many cases, yes, it's functionally a deferred debit card. It makes it almost impossible to rack up debt just by forgetting to pay a bill.
It's just a totally different philosophy on credit.
A completely different structure.
Yeah.
The idea of a universal credit score that's shared among all banks, that really doesn't exist in France in the same way. The system is just not built to encourage high-volume, revolving debt like the American model is.
So we've established the card's dual role, instrument of convenience, high-risk debt machine. But sometimes that accessible line of credit is used for something much, much riskier: entrepreneurial funding.
It sounds like a terrible idea, and statistically, it usually is. Over 80% of startups fail pretty quickly. But the ability to access quick, if expensive capital has led to some remarkable success stories.
It's the stuff of startup legend, right? Maxing out your personal plastic to buy the first server or cover the first few months of rent.
Len Bosack and Sandy Lerner, for instance, famously used personal credit cards to get the initial funding to launch Cisco systems.
And perhaps most famously, Larry Page and Sergey Brin used them for the very initial stage of Google. They specifically recalled using personal plastic to buy a terabyte of hard disks to get their first server running.
It's amazing that access to quick liquidity, even at a high APR, was essential when a traditional bank would have just laughed them out of the room.
And this wasn't just in tech. Filmmakers have done it too. Kevin Smith financed most of his breakout film clerks by maxing out several cards.
And Robert Townsend financed Hollywood Shuffle the same way. These are definitely outliers, but they're proof that for a select few, the high-interest accessibility of a credit card can be a temporary engine of innovation.
For the average consumer, though, the key is just awareness. And it's valuable to point out that some governments do offer neutral resources to help navigate this market.
Absolutely. We noted the Financial Consumer Agency of Canada, the FCAC, maintains a public database of nearly 200 different credit cards. It details every fee, feature, APR, all of it. These neutral comparison tools are so crucial.
So, okay, let's distill this into the core takeaways for our listener. The entire plastic economy really functions based on two major archetypes of the user.
Right. First, the card is a vital debt instrument for the revolvers, the people who carry a balance and, through high interest and fees, generate the main profit for the issuers.
And second, it's a convenience tool for the transactors.
The ones who pay in full every month.
Yeah.
And they fund the system by generating those lucrative interchange fees that merchants pay.
But the key, often unseen element is that regressive wealth transfer. The system, fueled by rewards, effectively transfers money. That estimated $1,000+ annually per family, from cash users and price-sensitive consumers to the high-volume card users.
So the credit card is not just a piece of plastic. It's an economic structure that influences consumption, debt levels, and wealth distribution. The convenience we demand is built on a fee structure that acts as a hidden mandatory tax on nearly every transaction in the modern economy.
So what does this all mean for the future of payments? We know the U.S. model thrives on these high, often hidden fees that reward sophisticated users. If merchant fees were capped globally, like in the EU, would this fundamentally change consumer behavior by killing the reward incentives? Or would card issuers just find new, more explicit ways to get revenue from the consumer?
Would that $1,282 annual subsidy just be transferred back to the consumer through higher annual fees, effectively ensuring that the system still finds a way for the poor to subsidize the profitable card market?
Something to mull over until our next deep dive.
A fascinating question of global financial engineering. Thank you for joining us.
We'll see you next time on the deep dive.